Okay, so March 10th, 2023. Silicon Valley Bank collapses. 48 hours later, Signature Bank fails. 72 hours after that, Credit Suisse, a 167-year-old Swiss banking giant, is on the verge of total collapse. 3 massive banks. 1 week. Now, here's what's absolutely insane about this. In 2008, when Lehman Brothers collapsed, it took 6 months for the crisis to spread globally. In 2023, it took 6 days. The contagion spread 4 times faster. And I spent the last 3 weeks going down this rabbit hole trying to figure out why. Why do financial crises spread faster now than ever before in history? And what I found is this thing that economists call the Contagion Coefficient, basically a mathematical measurement of how fast panic spreads through the financial system. And dude, this number has been growing exponentially. In 1929, the Contagion Coefficient was around 1.2. In 2008, it was 3. In 2023, it hit 7.8. That means the NEXT crisis could wipe out the global banking system in days instead of months. This is genuinely terrifying. Let's go. Alright, first let me explain what this thing even is. So, the Contagion Coefficient isn't like an official term you'll find in textbooks. It has this framework that a few economists admit and the Bank for International Settlements use. To measure financial panic spreading, here's the basic idea. Imagine you have 100 banks. One bank fails. The Contagion Coefficient tells you how many other banks will fail as a direct result. If the coefficient is 1.0, then one bank failure causes one other bank to fail. If it's 0.0, one failure causes 2 more failures, and so on. Now in a healthy financial system, the coefficient should be below 1.0, meaning failures are contained. They don't spread. But when the coefficient goes above 1.0, you get exponential contagion. 1 failure causes 2. Those to cause 4. Those for cause 8. It's like a nuclear chain reaction, but with banks. And here's what nobody talks about. This coefficient has been steadily increasing for the past 100 years. Let me show you the history. So, start with 1907, the Panic of 1907. This is actually the first time we can measure contagion speed in American banking history. October 1907, this trust company called Knickerbocker Trust in New York, 3rd largest trust in the city, it collapses, and panic spreads to other banks. But here's the thing, it spreads slowly. Day 1, Knickerbocker fails. Day 3, 2 other trust companies have bank runs. Day 7, 5 more banks facing runs. Day 14, the panic hits regional banks across the East Coast. It takes 2 weeks for the panic to spread from New York to Boston. 2 weeks. Why so slow? Because information moves slowly. There's no internet, no phones in most homes. News travels by telegraph and newspaper. If a bank failed in New York, you might not hear about it in Philadelphia for 24 to 48 hours. So the Contagion Coefficient in 1907 was about 1.2. One bank failure led to 1.2 other failures on average. It was bad, don't get me wrong, but it was containable. J.P. Morgan literally locked a bunch of bankers in his library and forced them to bail out the system. And it worked. But then everything changed. Fast forward to 1929. The stock market crashes in October. Banks start failing in November. But now we have radio. We have telephones becoming more common. Information spreads faster, and the contagion accelerates. Let me show you the timeline. November 1929, 150 banks failed. December 1929, 300 banks fail. By end of 1930, 1,350 banks have failed. That's 9x faster than 1907. And it keeps accelerating. 1931, 2,194 banks fail. That's 6 banks per day. 1932, 1,456 banks fail. 1933, over 4,000 banks fail. By the end, 9,000 banks are gone, 40% of all American banks. The Contagion Coefficient had jumped to about 2.1. One bank failure was now causing more failures on average. Why? Because information was spreading faster, and banks were more interconnected. See, in 1907, if a bank in New York failed, it didn't immediately affect a bank in Iowa. They weren't connected. But by 1929, banks were lending to each other. They held each other's bonds. They were part of the same financial system, so when one failed, it created a chain reaction. But even this was nothing compared to what was coming. Alright, September 15, 2008, Lehman Brothers collapses, and dude, the speed of contagion in 2008 was absolutely insane compared to anything before. Watch this timeline. September 15th. Lehman fails September 16th. Egg needs emergency $85 billion bailout September 17th. Reserve primary. Fund breaks the buck. First money market fund to fail in decades. September 25th. Washington Mutual fails. Largest bank failure in U.S. history September 29th. Wachovia on the verge of collapse October 6th. Iceland's entire banking system collapses October 8th. UK nationalizes several banks 1 month. The contagion went from Lehman to Iceland in THREE. Weeks. The coefficient had jumped to 3.4. One failure was now causing 3 to 4 other failures. Why so fast? 3 reasons. First, digital interconnection. Banks were linked through electronic trading systems. When Lehman's trades couldn't settle, it froze the entire system within hours. Second, derivatives. Lehman was counterparty to trillions in derivative contracts. When they failed, every bank that had a contract with them suddenly had massive losses instantly. Third, 24-hour news cycle. CNBC broadcasting the collapse in real time. Bloomberg terminals showing credit default swaps spiking, Twitter starting to spread panic. Information that took 2 weeks to spread in 1907. Now spread in 2 hours, but even 2008 looks slow compared to 2023. Okay, so March 8th, 2023. Wednesday, Silicon Valley Bank announces they sold their bond portfolio at a $1.8 billion loss. That's it, just an announcement. Thursday, March 9th, morning, venture capitalists start telling their portfolio companies to pull money out. Of SVB afternoon, $42 billion in withdrawal requests come in. That's 1/4 of SVB's total deposits in one day. Friday, March 10th, SVB is insolvent. FDIC takes over. Bank is gone. 48 hours from announcement to collapse. But wait, it gets crazier. Saturday, March 11th, Signature Bank in New York starts seeing massive withdrawals. They fail on Sunday. Monday, March 13th, Credit Suisse stock crashes. Rumors spread their necks. Tuesday, March 14th, First Republic Bank needs emergency funding. By March 17th, 1 week after SVB. COLAPSED, the entire global banking system is in crisis mode. The contagion coefficient hit 7.8. One bank failure was triggering 70 IGHT other bank crises. This is for X faster than 2008. So what changed? Alright, so I talked to some economists and former bank regulators to figure out why contagion is spreading so much faster now. And they pointed to 3 things. Accelerant number 1, social media in 2008. Twitter existed, but wasn't mainstream yet. In 2023, everyone's on Twitter, Reddit, TikTok. On March 9th, a venture capitalist tweeted, "Get your money out of SVB at 10:47 a.m. By 11 a.m., that tweet had 50,000 views. By noon, it had 500,000 views. By end of day, over 1 million people had seen it. And here's the thing, you can't stop a bank run once it is viral on social media. In 1933, FDR could close all banks for a week and calm people down with a radio speech. In 2023, if the president tried that, social media would explode with conspiracy theories and panic within minutes. Accelerant number 2, mobile banking in 2008. To withdraw your money, you had to physically go to a bank branch. That created natural speed limits. Banks could only fail as fast as people could drive there and wait in line. In 2023, you tap a button on your phone. $42 billion withdrawn from SVB in one day, most of it through mobile apps. One guy told me he transferred $3 million out of SVB while waiting in line at Starbucks. That speed is unprecedented in history. Accelerant number 3, algorithm trading. This is the scary one. In 2008, when banks got into trouble, humans made decisions about selling their stock or buying credit default swaps. In 2023, algorithms make those decisions when SVB's trouble was announced. Trading algorithms detected the news within milliseconds. They immediately shorted SVB stock, bought credit default swaps on SVB bonds, started selling stocks of a NY bank that had similar balance sheet structures to SVB. All automated, all happening at computer speed. Humans weren't even involved. Okay, so let me show you the actual math behind this because it's genuinely fascinating. Economists model contagion using something called the Eisenberg no-network model. Don't worry, I'm not going to make you do calculus, but here's the basic idea. Imagine banks as nodes in a network. Each connection between banks represents exposure, loans, derivatives, deposits, whatever. When one bank fails, it sends a shock through the network. The strength of that shock depends on how interconnected the banks are, how fast information spreads, how quickly people can act on that information. Now in 1907, low interconnection banks were mostly local slow information spread telegraph. Newspapers' slow action speed had to physically go to the bank. Contagion coefficient 1.2 in 2008. Medium interconnection banks trading with each other globally. Fast information spread. 24-hour news, early social media, medium action speed, online banking. But not mobile yet. Contagion coefficient 3.4 in 2023. Extremely high interconnection. Every bank connected through derivatives, digital payment systems, instant information spread, social media, Bloomberg terminals, instant action speed, mobile banking, algorithm trading. Contagion coefficient 7. 8. And here's the terrifying part. The model shows that once the coefficient crosses 8.0, contagion becomes impossible to stop, even if central banks step in immediately. The panic spreads faster than they can contain it. We're at 7.8 right now. We're one crisis away from that threshold. Let me walk you through exactly how a modern bank run happens, minute by minute, because this is important to understand. R0, the spark, something triggers concern. Maybe a bank reports losses. Maybe a rumor spreads. Doesn't matter. What matters is someone with a large following post about it on social media. R1, the influencer cascade. Other influencers see the post and amplify it. Just heard Bank X might be in trouble. I'm moving my money. Within an hour, millions of people are aware. R2 to 4, the sophisticated money moves. Hedge funds and institutional investors start pulling money out. Not because they know the bank is failing, but because they see everyone else pulling money and think better safe than sorry. This is rational behavior that creates irrational outcomes. R5 to 8, the retail panic. Regular people wake up, check their phones. See headlines, Bank X faces massive withdrawals. They think, oh crap, I have money there. They open their banking app and hit withdraw. R9 to 12, the death spiral. The bank now has $10 billion in withdrawal requests, but only $2 billion in cash. They start selling assets to raise cash, but they're selling at a loss. which makes their financial position worse, which causes more people to withdraw. Our 13 to 24. The collapsed bank can't meet withdrawal demands. Regulators step in. Bank is declared insolvent. Total time from spark to collapse, 24 hours. In 2008, this process took weeks. In 2023, it takes 1 day. Okay, so let me show you how this played out in real time with Credit Suisse, because this one is absolutely wild. March 14th, 2023, Tuesday afternoon, Credit Suisse's largest shareholder, Saudi National Bank, does an interview with Bloomberg. Reporter asks, will you provide more capital to Credit Suisse if they need it? Saudi banker says, no. That's it, one word, no. Within 5 minutes, Credit Suisse stock drops 8% credit. Default swap spike. Twitter explodes with Credit Suisse's next within 30 minutes. Stock down 15%, trading algorithms start shorting, investment banks start pulling credit lines. Within 2 hours, stock down 24%, Swiss regulators calling emergency meetings, other European bank stocks falling in sympathy. By end of day, Credit Suisse stock down 30%, $10 billion in deposits withdrawn. Swiss government preparing emergency takeover. From one interview to existential crisis in 8 hours. That's the contagion coefficient in action. Now, the Swiss National Bank stepped in with $54 billion in liquidity. They forced UBS to buy Credit Suisse. They stopped the collapse. But here's what's scary. If they'd waited even 24 hours longer, it would have spread to Deutsche Bank, BNP Paribas, and the entire European banking system. The contagion was that fast. Alright, so here's the uncomfortable truth that regulators don't want to talk about. The financial system now moves faster than government can respond. Let me break this down. In 2008, when Lehman collapsed on a Monday, the government had the entire week to figure out a response. They held meetings, they negotiated, they crafted bailout packages. It was stressful, but they had time. In 2023, by the time regulators even realized SVB was in trouble, it was already dead. The FDIC held an emergency board meeting on Friday morning to decide what to do. But by then, $42 billion had already left the bank. It was over. Now, the FDIC did something unprecedented. They guaranteed ALL deposits at SVB, even above the $250,000 insurance limit. This stopped the contagion, temporarily. But here's the problem. Next time, people will know the government will step in, which creates moral hazard. Banks will take bigger risks because they know they'll be bailed out. Depositors won't pay attention to bank safety because they know they're protected, and the next crisis will be even bigger. It's a doom loop, and governments are trapped in it. Okay, now let me show you something that keeps financial regulators up at night. Derivatives. In 2023, the global derivatives market is worth $600 trillion. That's not a typo. $600 trillion. For context, global GDP is only $100 trillion now. Most of these derivatives are hedges. They're supposed to reduce risk. But here's the problem. Every derivative contract has a counterparty. If I buy insurance against Bank X failing, someone has to sell me that insurance. And if Bank X actually fails, the seller has to pay up. But what if the seller can't pay? Then I lose money, and maybe I fail. Which means my counterparties lose money, and maybe they fail. This is called counterparty risk. And in a fast-moving contagion, counterparty risk can bring down the entire system in hours. Let me give you a real example. In March 2023, when Credit Suisse was collapsing, they had $54 trillion in derivative exposures. If Credit Suisse had actually failed instead of being acquired, every bank that had derivatives contracts with them would have taken losses. Many of those banks would have failed, which would have triggered their derivatives, which would have caused more failures. The Swiss National Bank estimated that if Credit Suisse had been allowed to fail, 40% of global banks would have been insolvent within 1 week. 40%, 1 week. That's the derivatives time bomb, and nobody knows how to defuse it. Alright, so the question everyone's asking, when's the next one? And look, I can't predict the future, nobody can. But I can show you the conditions that create financial crises. And pretty much all of them are present right now. Condition 1. High debt levels. Global debt is at all-time highs. Governments, corporations, households, everyone's leveraged. When interest rates rise, which they have, debt becomes harder to service. Defaults start happening. Condition 2. Asset bubbles. Stock market is at all-time highs despite economic weakness. Real estate prices in many cities are at bubble levels. Crypto had a massive bubble that's deflated but could reflate when bubbles pop. It triggers contagion. Condition 3. Banking sector stress. Remember, the contagion coefficient is at 7.8. Banks are more fragile than they appear. Many are sitting on massive unrealized losses in their bond portfolios. If they're forced to sell those bonds to meet withdrawals, they'd be insolvent. Condition 4. Geopolitical tension, wars, trade disputes, political instability. All of these can trigger a crisis. Right now we have all of the above. So, when does it happen? My guess, and this is just a guess, is sometime in 2025 to 2027. Here's why. The Fed will likely start cutting interest rates in 2024 to 2025. Rate cuts sound good, but they usually happen because the economy is weakening, and when the economy weakens, loan defaults increase. Banks take losses, and if one bank fails, well, you know what happens. Contagion coefficient of 7.8. Okay, so let me paint you a picture of what happens if the contagion coefficient crosses 10.0. Because some models show it could hit that level in the next crisis. A coefficient of 10.0 means one bank failure causes 10 other failures. Here's the timeline. Day 1, one major bank fails. Let's say Bank of America or Wells Fargo. Day 2, 10 other large banks are in crisis. Emergency Fed meetings. Markets halted. Day 3, those 10 banks each trigger 10 more. Now we have 100 banks failing. Day 4, the FDIC insurance fund runs out of money. It only has $125 billion. But the insured deposits at these banks total over $10 trillion, the government announces. Emergency measures. Day 5, international contagion. European banks fail because they had exposures to the US banks. Day 6, Chinese banks fail because they had derivative contracts with European banks. Day 7, ATM has stopped working. Credit cards don't work. Direct deposits don't happen. The entire global financial system has frozen. Now, would governments step in? Absolutely. They'd nationalize banks. They'd guarantee everything. They'd print whatever money is needed. But here's the thing. At that point, you're not worried about inflation anymore. You're worried about the complete collapse of the monetary system. And once trust is lost in the financial system, it's incredibly hard to restore. Ask anyone who lived through the Weimar hyperinflation or the Zimbabwe collapse. It's not pretty. All right, so this is all terrifying. I get it. But let me give you some practical things you can actually do. Thing 1, spread your deposits. Stick insurance covers $150,000 per account, per bank. If you have more than that, spread it across multiple banks. Don't keep $1 million in one bank. Put $150,000 in for different banks. Or thing 2, consider credit unions. Credit unions are generally more stable than commercial banks because they are not trying to maximize profits for shareholders. They're less likely to take risky bets. Thing 3, keep some cash at home. I'm not saying go full prepper, but having $1,000 minus $2,000 in physical cash at home isn't crazy. If ATM has stopped working for a few days during a crisis, you'll be glad you have it. Thing 4, understand your bank's exposure. Most banks publish financial statements. Look at their bond portfolio. If they have lots of long-term bonds purchased when rates were low, they're sitting on unrealized losses. That's a warning sign. Thing 5, don't panic, but pay attention. The next crisis is coming. We don't know when, but if you start seeing headlines about bank stress, don't ignore them. The contagion moves fast now. By the time the news says crisis, it might be too late to move your money. So look, here's the bottom line. Financial crises are spreading exponentially faster than they used to. What took 2 weeks in 1907 now takes 2 days. The contagion coefficient has gone from 1.2 to 7.8, and it's still growing. The next crisis could freeze the global financial system in 1 week. Governments can't respond that fast. Central banks can't print money that fast. The system is fundamentally unstable. Now, does that mean you should panic and pull all your money out of banks? No. That would actually cause the crisis. But it does mean you should be aware. Pay attention. Diversify. Have a plan. Because when the next crisis hits, you're going to have hours to respond, not weeks. The coefficient doesn't lie, and right now, it's screaming a warning that most people aren't hearing. Anyway, if this video changed how do you think about financial stability, share it. More people need to understand this. And hey, if you have questions, drop them in the comments. I'll try to respond. All right? I'll catch you in the next one. Stay safe out there.